Welcome back, everybody, to another 21st Century Renaissance and another open interest news at a breakdown on GameStop. I'm your host, Dr. Michael LoPiano. Today, we are talking about three factors that are looking to be quite operative in the immediate term with respect to our price action. That's going to concern this very high volume, I should say, very high premium exchange with respect to deep in the money short puts. We're also thinking about the relationship of those puts to some of this higher volume of shorter term short call bets, as well as this concept. Once again, we're going to revisit this concept of the 2x net asset value floor. So we'll be looking at that today. Before we get started, we go to our gratitude. Thanks go out to AmGo Blue. This is Jake Groff. For sponsoring today's article and video. Many thanks, as well as to our monthly supporters, Ken Wedberland and Not Medical Advice, for helping offset some of my data expenses on a rolling basis, on a monthly basis, I should say. Thanks as well to everybody who's been supporting the channel either in the past, has a thanks coming up for buying me a coffee, or has just expressed support for my research and publication here. Trying to spread some. Some attention, some knowledge around what I can figure out to the broader GME investing community. So thank you very much for everyone who has supported the channel. So some of the topics I've been seeing coming up, right? We talked about this a little bit yesterday. This was certainly present in the post yesterday in my article yesterday, where we talked about the importance of FOMC coming up. And that is this high volume of high relative to what this strike is, right? So we're seeing, we saw thousands of contracts, right? So we saw 105 puts, 100 puts, some 95s yesterday, and quite a large volume of 95 puts on Tuesday, which have come in, right, for January of next year. And these are, by and large, these are sold puts. So this looks to be one trader or institution who has just been hitting these in small batches. So this is very interesting. This does involve, this does appear to, based on our price action, this does appear to be the sort of trade that has been involving a significant market maker hedging. So by punching in the order in this particular way, this does necessitate that this particular hedging volume comes onto the lit market rather than getting bumped to a dark pool. So we can see on our price action, right, we see this volume come in, and we can see how our price action responds to the fact that these options trades are coming in, right? So options move markets in the particular sense that they force the options market maker, for GameStop in this case, this is Wolverine Trading, to go out into the lit market and to buy shares in order to hedge their position, buy or sell, right? So if it is a bearish trade, the options market maker will go into delta and gamma hedge their position by shorting shares. If it is a bullish trade, they will go out into the lit market and purchase shares. So we've seen that, typically block orders have come in. When they come in, right, they don't go to Wolverine, they don't go to the options market maker, they go to the equities market maker, who in this case is Citadel Securities. And we've seen that a very large volume of these bigger block orders, when they've come in, whether they be qualifying contingent trades or just simple large blocks of ask volume, they've been bumped to the dark pool in a pretty interesting proportion. So that's not happening here, right? We are seeing this hedging flow come on into the lit market. So this is, what's very interesting is yesterday, this represented about 10% of our total volume was the options market maker buying shares to hedge these positions. All right, so these are, even though these are all the way out in January, these are essentially, these are so deep in the money that these are way one delta contracts, which means that the options market maker, when they get this trade, when they take this trade, they go out and they buy the full 100 shares that each contract corresponds to. So this has represented certainly more than 500,000 shares. Between both days of trading, it's been certainly over 40 million, close to $50 million in the premium values of these trades. And probably something close to about 600,000 shares have had to have been purchased by Wolverine Trading on Tuesday and yesterday as a result of these trades. So that's very interesting. I mean, a lot of people have been wondering, is this roaring kitty? Like, what's going on here? Why would you take this trade? I mean, I would definitely give a shout out to Eric from Outlier Trading. He had a pretty good video where he just kind of looked at, okay, like, would this make sense, like from kind of an interest rate like type decision, like would this make sense in terms of an extrinsic value play? Like, is this trying to profit off of IV or something like that? And yeah, largely his conclusion, this is something right, which seems to be the case. This isn't a play to specifically, right? These are so deep in the money that what you're essentially betting on here is a change in the intrinsic value of the contract. So that's, I mean, in general, right? That's how I tend to target when I go not so much short options, but when I go long options, which is very infrequently. I don't do that a lot. When I do that, that's typically what I target, right? So I look to target intrinsic value simply to get more leverage on my cash, so 2 or 3 times the leverage, but in such a way that does not leave me exposed to, say, a complete loss of my position based on, say, the contract going out of the money by expiry, right? That's one of the ways that I avoid trading. I don't trade that way. So this is it's a short put, right? It's a bullish trade from the surface. And what this does look like is this looks like, a synthetic long position on the stock. You're essentially betting, right? So your downside on this trade is $2,600 per contract, right? So it's essentially the same as 100 shares. Your downside is the value of 100 shares, and your upside. So you have a capped upside, but it's a big upside, right? So your capped upside, I think, is something like 70, well, for the hundreds, right, it's like 7,400, 7,300 per 100 shares. On the 95s, it's slightly higher. On the 105s, it's slightly lower, right? So on the 105s, or sorry, on the 105s, it's slightly higher. On the 95s, it's slightly lower. So on the 105s, you're capped at like, 8, what would this be, 7,900 per share, 7,900 per contract. And this is something like, if we could average that between, the 105, we'd say that your gain is probably capped at something like 7,400, per contract. So it does look like several thousand of these are there, right? So, yeah, I mean, this doesn't have to go to 105. I would say that probably what this trade suggests is that this trader does not expect, or whoever this is, in the next 7-ish months, does not anticipate the price of GameStop to go above $95. I mean, I think that's probably a reasonable expectation for that time frame. The only loss there is then if it does, these however far above, say, 95 or 100 or 105 the price of the underlying goes, this trader will not benefit from anything above that. But if that does happen, I mean, I'm sure this trader is not going to be upset with something like however many hundreds of millions of dollars that they'll profit on this, right? So it's 40 million. The max gain across probably all of these contracts is something like $120 million, I think, something like that. Not a bad trade, right? Not a bad trade. The other thing about this, right, is this doesn't require the actual holding of these shares on the trader's books. The shares are being held, but they're being held by the options market maker. So what's going on here, right? Why do this as opposed to just going out and buying shares? It could be that right, whoever this was did not want the trade going to the equities market maker, knowing that the trade would be internalized. In so doing, this trader knows that by using a synthetic long position, someone is going out and buying these shares. In fact, right, I mean, we've talked about short puts before. When you do a short put trade, right, so if you go out and you just limit buy the stock, you don't, I mean, this is what the DRS crowd basically is up in arms about. When you go out and you buy the stock with a limit buy, like through a brokerage, you're probably not getting shares. Well, number one, you're not holding them in your name. That's the whole DRS issue. But you may not even be having real shares, right? You probably have an IOU. It could be like cash in lieu of that. You could have some sort of rehypothecated shadow of a share from an ETF or something like that. But the thing about a short put is if you go and you sell a short put, if it's deep in the money, for example, you ensure that the options market maker must go out and acquire those shares. So the thing with your buy volume, right, your limit order, is it's not going to affect the price during the day. The reason why, let's say, we talk about options flow and not about major stock orders is because the stock orders, as we've seen by and large, these get dark pooled, these get internalized. These don't actually affect the price. These don't affect the bid-ask quotes. The volume is shown as a volume of shares traded, but it doesn't affect what's going on, right? And we've seen that happen. We can see hundreds of thousands of shares come in as a block. We'll see that on the tape, but then the stock price won't move. So what's happening there is, right, that order is being internalized. What's very interesting about taking a synthetic long position like this via deep in the money short puts is the options market maker must, by regulation, go out and purchase these shares. So, I mean, this is not financial advice, but when making a decision to acquire, shares, to acquire, say, a long position in the underlying, if you as a trader go out and purchase a deep in the money, or excuse me, not purchase, sell, meaning go short, meaning write a deep in the money put, yes, what you're sacrificing there is you are sacrificing unlimited upside gain in the short term, I suppose, with this contract. If the price goes above, right? So if this goes above $105, this person doesn't get shares, right? This person won't get shares, won't be able to exercise the contract for shares. They'll get paid out all of the premium that corresponds to this contract, but they won't be able to exercise it for shares. So it won't be unlimited. And of course, it has an expiry date, but most likely this will expire in the money, and this individual will get assigned shares at some point. They'll have to purchase shares for $95 a share. Okay, but the options market maker, when this trade comes in, will go out and buy actual shares and attempt to have those settled, right? So that's something that's different. You could enter in a limit buy and your block of shares could get internalized, and who knows when those are ever actually going to be purchased and then affect the price intraday. But if you attempt to acquire shares via short puts, especially deep in the money, which are 1 delta, when you send in that order, the options market maker is going to go out and buy those shares in such a fashion as they will affect the price of the underlying. So what is, I think, the most operative for me about this trade is whoever is making this trade, right? Because why not just go buy shares? Whoever is making this trade is doing so in such a fashion, in such a wise, as to ensure that the shares that correspond to this synthetic long position are being purchased as these orders come in, to ensure that it's not being dark pooled, to ensure that it's not being internalized. So very interesting thing to consider there. Right, and just to get a sense, right? So one of the Ultimator 5 also put out an options volume indicator here. So just to give you a sense, right, we have seen these type of things come in before. So we saw a ton of synthetic longs back in May and June. We saw a bunch in sort of late June, kind of August, a little clustering there. Very quiet, basically fallow from late August all the way into our basically mid-November. And just about mid-November, so what's very interesting, right? This was following the November 7th unexpected Fed rate cut. So not before that, not even at the start of our November run here, but only once the run began in earnest following the November 7th rate cut did we start to see this type of order come in. We got another one in December. So what I expect is that, well, what this seems to suggest to me is that this type of activity may have something to do with interest rate swaps. May have something to do with it. It may not, right? We saw a bunch in January, we saw a little bit in February, and then in February they just disappeared, completely disappeared. Nothing in February, nothing in March, right? Very little in March. Early April, not so much. Late April, we got a little bit of cluster of this stuff, and then oh my heavens, oh my stars, that's a lot, right? What we've seen in the past 2 days is pretty close to all of the activity that we've seen over the past year combined. So that's a lot. That's a lot in terms of contracts. That's a lot in terms of premium. Okay, so very interesting to see that taking place now. Very interesting to see that taking place now, especially as we start to get some signals from altimeters. Right, we are getting close to a signal here on altimeters bottom finder. And as we are, of course, thinking about FOMC, what just came in yesterday, right? Rates are going to be held steady, but that doesn't mean that there isn't synthetic positioning in order to properly account for the risks of an interest rate swap. So perhaps this has something to do with interest rate swaps. What does that mean for our price action going forward? In general, in terms of yesterday's meeting, so what I talked about yesterday as possibly the Fed's forward guidance on the rate change, right? So the rate change itself, nothing was expected to change yesterday. There was about a 3% chance we'd see a rate cut. Assessed by probability. We talked about that. But it was more so the forward guidance. And it does seem that the market in general has responded well to the Fed's forward guidance, which is that they reiterated the four potential cuts for this year, 4 expected cuts for this year. It just seems though that they are coming later in the year. So for example, if we go over and look at, look over here at sort of expected, right? So this is FedWatch, take a look at cuts. So we can see that the expectation of a cut also has fallen for June. The probability has fallen from about 30% down to about 17 now over on FedWatch. So it's fallen by almost half. So that's expected to stay steady. So this definitely inspires some stability heading into June OPEX. As we look forward, right, July then starts to look up. And why are these probabilities up here? Well, if the Fed is going to stay in line, the indication is that, yes, it does look like the Fed is going to stick with the expectation of the 4 cuts. They basically need to start in July, right? There are only 4 more meetings after June this year. So if it doesn't come in June, there's got to be one in July or September and October and December. So that's very interesting. That's typically going to correspond with bullish price action. That's basically right. I mean, how to read the tea leaves here. This is basically saying, okay, broader market. So none now. We're probably not going to do one in June, but we're sticking with the 4. Right, we want to see inflation go down. We want to see these numbers a bit better. We're going to stay flexible, but we're not altering this kind of 4 cut expectation. All right, that basically says not June, but we're going to do 4 cuts. It's going to happen from July on. So when those actually get actualized, right? When those come in, when those get realized, I mean, how big are they going to be? That's a different question. So that's kind of still speculative there. Right, we're probably going to see this probability here of there being no cut in July. This is probably going to dwindle as we get closer to June and as we get closer to July, and we see things like, we see inflation, we see CPI and PPI and the like, labor market, something like that. Okay, so what did that mean? How can we tell that traders responded to that pretty well? Well, we stayed pretty stable, and we actually have been staying pretty stable. I mean, we've been coming down, so we did come off of this kind of test of the 200-day moving average. We have been kind of trending down there. I think the 50-week as well is right up there. We've been trending down, even though we have green candles, right? We are moving down, but we seem to have found some support on top of the 50-day here. And if we go and take a look at our options landscape, Oh, Nelly, do we have a reconfiguration of our options landscape, especially in terms of GEX? So, right, we've been looking at mostly a put dominant environment. It has softened from what we saw in April. April looked like May not going to be so grand, but we did see a little bit of reprieve. Say last week, we start into the end of the week. This week, maybe a little bit of uncertainty crept back in. Volatility didn't super ramp up, but we did start to move back to the downside like we talked about earlier in the week. What we saw yesterday was what appears to have been a large volume of put closures, repositioning, possibly some short call selling. But what we can see is that our net put gamma distributions across future expiries has way shifted. It's way down. I mean, we were looking at huge concentrations for May, huge concentrations for June soon. Again, not as big as what we saw in April, not as big as what we saw in March, but still outsized. What we have going into today is a very call GEX biased day. Friday as well, very call GEX biased. This is very stable. This is low volatility. This is kind of grindy, meandering, maybe slightly go up. And we see traders also kind of setting up for the beginning of next week to look like that. Those are the types of conditions that we want to see in the broader market that may give us an indication that, okay, this is good for GameStop maybe to move up as well. What's really great to see is, whoa, has May OPEX evened out? Doesn't mean there's position that all of the positioning to account for some uncertainty is gone, but it is way less, blood and gore. What we see also heading into the end of May is way softened. June OPEX is now way softened. So this largely projects stability. Some preparation rate. Obviously, there's some insurance there to hedge against downside, but it's way softer. It's way softer, and this definitely projects well heading into the next couple months, at least in terms of less volatility and therefore less anticipation of, say, something like imminent downside. Obviously, we can always get a dice roll from DJT, from the White House, from something like that, from geopolitics. I don't know, Pakistan and India go to war or something. I don't know. But that's much less of a concern. What I wanted to point out today, I mean, largely in our technical and options landscape, liquidity hasn't changed much. It's still up. Technical wise, what was very satisfying was to see us find support there once again at the 104 hour. So kind of double testing that support there. We are moving up pre-market, which is good to see, especially after this whoa Nelly of an altimeter bottom finder indicator. Altimeter's bottom finder also showing up on the daily, not quite showing a spike, but it's getting into that steep territory there, right? This lady gobble formation, as he called it, also corresponded with the bottom, even though it didn't really trip the white indicator there. The other thing too is, as I mentioned, right, we basically have tested, we've come pretty close to the sort of conservative scenario 2x net asset value floor. So that's basically, right, we've talked about this, that's where we held up. So that's back here, right? This is where we held up. So we might ask, right, why did we kind of bottom out at 1930 following the at-the-market offering there? Well, that was 2x our net asset value at the time. Right, our 2x cash, essentially valuing the business at zero. We bottomed out at 1930 because that was about 2x our cash value. All right, then we came up, right? We got the interest rate decision on September 18th, September 20th, big volume. We got the news that the at-the-market offering, the 20 million share at-the-market offering was complete. GameStop had about a little over 400 million additional monies on hand. And so when we came back down in October, where did we come down? About 2030. We only got down to about 2030. Why? Our net asset value had increased. That accounted for that extra $400+ million. All right, then we did this whole thing, which appears to have been in relation to whatever Roaring Kitty was basically signaling with the FTDs. Not sure exactly what was going on there with Cat Day. But then also, additionally, we had a rate decision on November 7th. So right around here, right here, exactly, this little red candle. as you can see, right? So this move was in reaction to a big rate cut, 50 basis point rate cut. December 18th is right here. So we got another rate cut right here, 25 basis points. Up we go, and this. All right, then we get short into rolling these swaps, right? So we got to roll the 311 swaps, then we recover a little bit, or 313, 311, 313, roll these swaps, recover into earnings, whoa, amazing, and then down into this swap. So this was bond arbitrage shorting into this to roll this swap. And then why did we come down into kind of the upper 20s? Well, we had a little bit more cash on hand at that point. We had a little bit more cash on that point from that hand, from interest earned on all of our cash. I think it came to about $130 million on our cash pile. So that reflected the additional inflow of cash as of earnings. And then on April 1, we got the notice that the convertible bond offering was completed and that we had received another 1.5 billion in cash. 1.48 billion is a bit more precise. Right, that's basically where we are now. If you take that 2x cash bottom and you account for all of the implied 50 million or so shares of outstanding that the bonds, right? So there's about 50 million new shares outstanding implied by the bonds. That comes out to something like $25.35. We've also got another 40 or 50 million, I think around 40 million in cash coming in from the sale of EB Games Canada or EB Canada. So that's more on the cash pile. You put that 40 million on it, no expansion of the outstanding, take off that liability that was losing money. We should around this kind of 2570 level in here, 2560s. That's pretty darn close to our 2x net asset value floor. So is that what we're seeing now? Is 2560 the new 2083? Is it the new 2030 being the new 1930, right? Is that what we're looking at now? Well, we'll see if this 2x net asset value floor hypothesis continues to stand up. And sort of the last thing that I wanted to point out, right? Okay, this does look like the building out of a synthetic long position on the part of an institution. Could it be that these large volumes of short calls that we saw come in earlier in the week were put specifically in place because there was an intention on the part of such an institution to engage in the opening of such a synthetic long position without significantly disrupting the price of the underlying, given the expectation that we would find ourselves on this 2x net asset value floor. And what we can see is basically from where we are here at around $26, all on top of us for just this week, right? So this is our GEX for this week, is all short call GEX. It's essentially all net short call GEX. Next week and the week after, not so much, right? That's more back to what we're used to, skewed long. But basically what this says is as we move up, we go into these, I think I described them as molasses conditions between 26 and 29. We've got net options long delta and gamma on the part of the dealer, which means the dealers are hedging that. So this is right, Wolverine Trading is hedging this by shorting shares of the underlying, by selling shares of the underlying. Okay, well, so these short puts are coming in, right? These short puts, these deep in the money short puts are coming in, and they're corresponding to hundreds of thousands of shares of long hedging on the part of the dealer, right? But then that's of course being countered by the fact that okay, we're getting some short call gamma as the price moves up. So as we move up, right, the call gamma on those calls is going up as they're about to go in the money, and so now the dealers are going out and they're they're selling shares in order to remain properly hedged as their long calls, trader short calls, have their gamma values and their delta values increasing. So there's a sort of loggerhead here. We're kind of getting like gamma pinned. It's like a clamp in this kind of 26 to 27 area. If we can escape this week, I mean, if something happens that pushes us over that, then I think that like next week's $30 position starts to pick us up a bit as we approach it, not necessarily beyond that point, but as we approach it, there isn't really anything much north of that $30 position next week, as we can see. Right, there's some, and these are probably long. Some of them, I don't know, for to be precise, to be honest. Right, we're looking at that this week. If all of a sudden that starts to come off the board, if we should overcome that position, or simply we find ourselves it's next week and those calls are gone without being rolled, then we might have some more upside room. We could see moving back into the 27, 28, 29, maybe even range, finally get that kind of 29, 50, 30-ish test that we've been waiting for, that we've been kind of hemmed in and not able to access there. So interesting to continue to evaluate whether we're going to see some price action as a result of interest rate swap rolls, as a result or in reaction to this forward guidance from FOMC yesterday. Just very interesting to continue to monitor that situation. Yeah, we'll have, looking forward to being able to come out with our video for tomorrow and see if we have any, anything else to elaborate on there, to see if these short put trades end up continuing at all. And yeah, of course, we're going to have our live stream 4 p.m. Eastern time. So after market close, right at market close tomorrow, Friday. Look forward to seeing all you guys there. We'll talk about what's going on, can elaborate a bit more. I'll put some more thought to thinking about what's going on with options right now, and try to elaborate on that a bit more, see if I can't come up with anything. So thanks very much, as always, for watching and listening. Looking forward to seeing you guys tomorrow for our next open interest newsletter breakdown, and tomorrow night for our live stream. So thanks very much. Take care.